Welcome to the Investing Channel, where we're looking at companies reporting later this week in the US. Starting off with Google owner Alphabet, where you can see that the shares have pushed up to their 200-day moving average at $1,127. That's really been the top of the range since the middle of October, so we'll see whether the latest from the company gets the stock over the top, so to speak. Of late, Google's been discovered to be running a data collection app that violated Apple's policies, so that didn't help the sentiment towards the company very much, and that came in the aftermath of Facebook doing allegedly a similar type of trick as well with its data. So the social media companies and the tech companies very much in focus at the moment on these kind of troublesome issues. As far as where we see Google shares or Alphabet shares going after an $1,127 break, it could be up to $1,200, which was the early October peak. Going on to Disney, less controversial here. In fact, the most controversial thing here probably the launch of its streaming service, which should come in later this year. That could give companies like Netflix and Amazon Prime a run for their money, given that most of the content that especially the younger viewers want to see are Disney-related films and series. As far as the technicals are concerned here, you can see that after the sharp dip at the end of December, we've seen a equally sharp rise for the stock back above the 200-day moving average at $109. And while that holds, the target here on a technical basis towards $115. So if the update from Disney is received well, that's what one would expect to see come through there on the share price. As far as Snap, the next company on the menu here, we've had the shares break a falling wedge formation, which was running on the daily chart since August. That was broken at the end of December around the $5.50 area. We're now well above that, broken through the 50-day moving average at $6 and heading for around the $7 area. Breaking higher than this, though, could be difficult. The company in the spotlight after the recent disappearance or exit of its CFO. That's not normally a good sign for a company. It normally means that something has been rather difficult in the financial area. But a break of $7 here could take the shares back as high as $9 to $10, which is where the 200-day moving average is. The stop loss on the buy scenario there back below the 50-day moving average. So the risk reward reasonable at current levels. Finishing off with fellow social media group Twitter. And Twitter in focus on a fundamental basis, given its problems, alleged problems with hate speech and misinformation and fake news and things like that on its platform. The shares have been in a range effectively from $27 to $36 in the post-August period after that massive gap to the downside. What the bulls are looking for here would be a break of the 200-day line, preferably on a weekly close at $34 to give the stock a chance of breaking the $37 area. But at the moment, given all the headwinds in terms of the fundamentals and the negative press that companies like Twitter are getting, it would appear that it'll have to serve up something quite special to break the top of that range at $37.